Welcome to another Lunch and Learn with Sterling Risk Advisors. Today we're talking about alternative risk transfer with Bev West from Sterling. So first thing I want to talk about is an important concept, and Bev's going to get into this in a lot more detail, but when you think about $1, how many pennies can you put in there? 100 pennies. That's all you can get out of $1. So Bev's going to get into why that matters today. So we're going to talk about alternative risk transfer, which is a product or a channel or a solution that transfers risk exposures between the insurance and reinsurance sectors and the capital markets in order to achieve specific risk management goals. It's a regulatory diversification benefit, and Bev's going to get a little more into that in a second. So the most readily explored and implemented types of alternative risk transfer are retrospective rating programs, large deductibles of $100,000 or more, self-insured retentions of $100,000 or more, qualified self-insurance, and the last thing is captives. And as I said, these are the most explored and implemented types of ART in the insurance world. So what is the total cost of risk? It's a measurement or a yardstick of the overall cost associated with the risks inherent within a company and the management of those costs. It's a quantifiable figure that can be identified and can be measured and managed. But it goes beyond the premiums paid to insurers. Risk control, administrative costs, and the costs of self-retained losses are all included in TCOR. And now let's hear from Bev.
In a more traditional structure of buying insurance, just kind of use this as a benchmark. 98% is risk transfer, and 2% is risk management. So, and risk management would be anything, including the time that you spend on your insurance renewal, meeting with loss control representatives of companies, etc. When you get into an alternative risk structure, it kind of breaks it down a little bit different, where you're buying some risk transfer, but you also have administrative costs. You have deductibles or self-insured retentions, and some taxes and fees. And these aren't necessarily accurate percentages, but just kind of gives you an idea that it's not just one number. And when is risk retention a viable option as part of your TCOR? Again, I consider this another one of the most important slides here. And its owners and senior managements have a commitment to manage, control, and retain risk in order to reduce TCOR. And I've been at this almost 40 years, and I've never seen a successful program work unless it had the support of senior management. Guy at the top of the food chain is most important. The retained risks are reasonably predictable, quantifiable. You can measure them, you can manage them. You don't want to retain something that you can't manage, you can't predict. Your company has a balance sheet and an income statement that has sufficient reserves and value to retain risk, because if things do go worse than you're thinking, you want to have the financial resources to handle them. And you're committed to a long-term program, because most of these programs, it's kind of hard to switch back and forth between buying a guaranteed cost, first dollar insurance program once you've gone into a program where you're retaining risk. Again, requires a commitment to risk control, claims management, since losses are going to become a part of your total cost of risk. And you can't really control your total cost of risk without the commitment and without already having things in place. It's kind of like you don't want to go into an alternative risk program if you have really poor loss experience and you haven't done the things from a risk control and claims management perspective, because it won't solve your cost problem. A retrospective rated program, these are pretty much the terms that you'd see if you received a proposal. for a retrospective rating program. The subject premium is the premium that is subject to the retrospective rating agreement. Non-subject is not. You can generally limit the amount of your losses that go into the calculation, and I'm going to show you that. A basic factor, which builds in the insurance company's expenses, their profit, and the cost of risk transfer, the insurance. There's tax. There's cost to adjust the claims. Everything is subject to a minimum and a maximum premium. And you'll have a retrospective claim agreement, which is a contractual agreement between the insured and the insurance company, where you are contractually obligated based on what is agreed to in terms of how the premium is going to be calculated after the policy expires, making it a retrospective rated premium. This is just a formula that is used to calculate a retrospective rating program. The basic being the expenses. An excess loss premium charge just adds another premium charge. Your limited losses that you assume and you pay, the cost to adjust those claims, the tax that is a pass-through. It's what the regulators, state of Georgia, state of Florida, comes up with our retrospective premium, and then a non-subject premium is added to that to come up with the total premium. And it's subject to a minimum and a maximum in the plan agreement. And the first adjustment is usually 18 months after the policy expires, and then every 12 months after, until all the claims are closed, or unless there's a mutual agreement between the insured and the insurance company to end the plan.
The big picture on this is, because he's throwing a lot of words at you, is that the carrier would establish a minimum premium, and then they would also establish a maximum premium. And the number between those numbers is the opportunity of the program.
And this is this is just an example. If we had a $100,000 premium, let's say workers' compensation premium, and our basic was 0.35. Again, that's an insurance company expense factor. We were limited the losses going into the calculation to $300,000. We were paying the insurance company 10% to adjust the claims. We were paying the state 5% in taxes. The limited losses were $300,000. Our loss limit is $250,000. We had non-subject premium, which is TRIA, and expense constants, surcharges and assessments. And we had a minimum on that of 50% and a maximum of $175,000, which means the minimum is our what the minimum is the insurance company is going to charge after the fact. And as Doug pointed out, the opportunity is you paid in $1 million. You might only pay half of that, 50%, because that's the minimum. But if your losses are not very good, you could pay $1,750,000. So you have an upswing and a downswing on this type of program. And what I did here is just went through a calculation where the losses were $300,000. So the premium was $735 plus another $500. So there would be that would be your ultimate cost under the retrospective rated program. So we've saved a little over $250,000 by assuming the first $250,000 of every loss, and we've controlled those losses, we've managed those claims, we've done all the things so that we didn't have to pay $1 million to an insurance company. Because if we paid $1 million to an insurance company and my losses were only $300,000, then who keeps the delta? The insurance company does. So this is a way for them not to be unduly enriched, so to speak. Self-insured retention is different. Self-insured retention is a structure where you're responsible to pay the defense and the claims costs and expenses in addition to the indemnity payments until the self-insured retention is exhausted. So that could be anywhere from $5,000 self-insured retention to $100,000 to $250,000. and you pay and control all the claims within the self-insured retention. Generally, you'll hire a third-party administrator to do that. And one of the key things is certificates of insurance must show the self-insured retention. So when you evidence the coverage, somebody is going to see that you have the self-insured retention and may question that, or you may be outside of the what is required by a contractual obligation that you have with third parties. There's a difference between a self-insured retention and a deductible. The insurer's responsibility in the event of a loss is reporting a claim, and generally as self-insured retention, the claim will be, the claims that have to be reported fall within certain criteria as outlined in the policy. Where under a deductible, you just report every claim. And deductible will generally require collateral, which we'll talk about later. Defense costs are generally handled differently between the self-insured retention and deductible. Already mentioned certificate of insurance, and then your erosion of limits. The self-insured retention may erode the limit, excess of the self-insured retention, or generally in a deductible, the limit is the limit. If you buy $1 million limit with a $250,000 deductible, the limit is still $1 million. When we talk about deductibles in the third-party world, they're not the same as they are when you buy property insurance. When you get a workers' comp, general liability, or commercial auto deductible, the insurer must pay those claims and then seek reimbursement from the insured. So it functions differently, but because they have to seek reimbursement from the insured, it creates a credit risk to the insurance company. So the insurance company may pay that claim. They want to make sure that the insured can pay them back.
Hey, Bev, I have a question about the in the self-insured retention with the legal costs. So does that agreement need to be made on who the attorney is going to be up front? Because the carrier is going to maybe want their attorney. How does that?
Well, generally you'll have a third-party administrator. But I will tell you from my own experience, and I did a lot of self-insured retention business with when I was at Discovery, and we did it on municipalities as well as private enterprises. And we didn't even get involved in the claim until it hit one of the thresholds that was outlined in the policy. We didn't even get the reports. So, for example, one of them was, fatality. So if we had a general liability and somebody was killed, third party was killed in that, we'd get notified. If they were injured, we didn't even know about it. So it's generally, the insured will hire a third party. Some larger insurers, for example, I used to insure Food Lion, the supermarket chain headquartered up in Salisbury. They had an in-house claims operation. They handled their own claims. So it just varies with the, it varies with what you're dealing with. So, but the bigger the self-insured retention, the more control. Self-insure, this generally only applies to workers' comp and automobile liability where you qualify with the state to be a self-insured. And it has its own approval process, its own restrictions, its own retention limits, and its own security requirements. And if you're self-insured, and there's 51 states, there's 51 separate requirements depending on every state and what they do, what they require. But it does apply to workers' compensation and automobile liability. A qualified self-insured, you meet regulatory requirements. The state regulators determine who qualifies. If they don't think you have the financial wherewithal, they don't approve you. Generally, a self-insured will buy some type of insurance for catastrophic losses. The state will require a bond, generally. And the self-insured will hire a third-party administrator. Again, so much of that is based on what the state regulators will allow to be done. But it is a viable ARC structure. A large deductible, here Hermie says it's a cash flow workers' compensation program that allows the insured to retain a portion of each loss to a substantial deductible and transfer onto an insured losses in excess of that deductible. Large deductibles can be also third-party liability insurance, general liability, and automobile. And as I mentioned earlier, deductible is different because the deductible, we can certificate that it's first dollar coverage because the insurance company has an obligation to pay the claim and then seek reimbursement from the insured for the claim that's paid. These are generally the components of it. You'll have an insurance charge, which stops losses, severity losses, and stops frequency losses. The insurance company's profit. Board fees and taxes are just pass-throughs from regulators in the state. You'll have residual market loads, which cover the obligation of the insurance company in the assigned risk, the broker commission, and then loss control. There'll also be TRIA, which is terrorism, expense constant, surcharges, and assessments. And the way these can be structured is you can pay as you go on paid losses or incurred losses. Incurred loss are paid plus reserve. So different companies will structure them differently depending on an insured's needs. And there'll be a cost to adjust the claims. Either the insurance company will adjust them, or some companies will allow you to hire a third-party administrator where you have a lot more control. And the cost of claims can either be as a factor of the amount of the loss or a per claimant charge. And then included in a large deductible, there's always collateral that's required because the insurance company wants to make sure that you can reimburse them for the amount of the losses that they have paid. And generally that's cash, a letter of credit, or a trust.
And that's the price of your third party since you've got full coverage, even though you've got a large deductible. Because like Bev said, we can show a certificate that shows full coverage, unlike in the SIR situation where you've got to show the counterparty that there's a self-insured retention, and then they can make a decision whether they want to deal with you or they want to, force you to give them some security or, show them financial strength to back the SIR. In this case, the insurance company's on the front end, so they want to be collateralized and they don't get stuck with unpaid deductibles.
Right. Generally, this is kind of another example where again, say for workers' compensation, we had a premium of $1 million. We had a deductible premium of $300,000, another $2,000 for TRIA and surcharges and assessments. Our deductible is $250,000. Our ultimate losses, let's say for this example of $350,000, we were able to stop the bleeding on losses at $700,000, or 2 times the expected loss, which is not an unusual number. The cost to adjust the claim is 10% of the losses, and our collateral is $700,000. And you would have to add to that the cost of obtaining the letter of credit or the time value of money as opposed to cash. And here, one of the major differences is in retrospective rating plans, the losses are considered premium because we're using a formula to develop the ultimate premium cost. Under a large deductible reimbursements are not premium, so there's no premium tax charged on those. It's a pretty big difference. But there are issues in terms of tax deductibility and loss reserves, which we deem to be a matter for your tax professionals. Here we have why is collateral needed. The first thing the insurance company says is that we have the rating bodies like DAS, S&P, Moody's, Fitch, we have different accounting standards for insurance companies than we do for other businesses. And if we had an uncollateralized obligation from one of our insureds, the rating agencies would say that's an uncollateralized obligation and we're not going to rate you as highly as a result of that. So the insurance companies want to make sure that they have those obligations from their insureds secured. And then the other thing is the credit risk that we talked about.
So those of y'all that do bonding, this first one is like officer, receivables, where the surety company doesn't count them as an asset. That's essentially the same thing
Right.
here. The insurance company's books, if they hold a bunch of receivables from insureds, the regulators don't count that as an asset unless it's collateralized.
So as a reminder, captive insurance is an alternative to self-insurance in which a parent group or groups create a licensed insurance company to provide coverage for itself.
But the intent is to use that captive as a means to retain and fund losses within a retention that you are willing to assume. And there's some reasons you may want to do that are both financial as well as risk management, because it does formalize how you retain those losses. The advantages, and if you Google captive, you're going to see these 5 things over and over again, because everybody talks about reduction in the risk costs, cover uninsured risk. The captive allows you to participate in the underwriting profits because you own the insurance company. You have direct access to insurance markets that are called reinsurance markets, and I'll have a slide on that. And you participate in the earned investment income because as you set reserves aside, those reserves can earn investment income before they're paid out as claims. There's different types of captives. Single parent is one where you own a business, you also own the captive. They have what they call a mini or micro captive, which is very popular today. It's set up under Internal Revenue Code 831B because the maximum premium that you can put in there is $2.5 million. In that particular captive, one of the reasons it's so popular is you don't pay tax on the underwriting profits, you only pay tax on the investment income that the captive earns. So they've become very popular, particularly for mid-sized businesses.
So the insured gets to deduct the premiums, pre-tax, and get the tax lift, and then the insurance company that the insured owns does not have to recognize profit until it's.
Well, they don't have to actually pay tax on the profit at all under 831B. They only have to pay tax on the investment income earned by the captive, which is a really, really good deal.
And then they get to treat it as dividends when they distribute it, rather than ordinary income.
Right. A sponsored captive, this is what I work for in Bermuda. It's a captive that was established by a third party. It's capitalized by a third party. You'll hear the term rental captives or rent-a-captive, segregated sale rent-a-captives, or all types of sponsored captives. This is where if you don't want to set up your own captive, you can rent space in somebody else's captive and not have the financial obligation of the ownership, capitalization, and you can also, it's easier to get entry and exit, in and out is a lot easier if you just rent the captive. And then group captives, and there can be group captives that have all homogeneous risk or all heterogeneous risk, and they're established to share risk within a group of participants to control cost. And that's very popular with smaller accounts that are maybe paying $250,000, $350,000 in premium. They can participate in a group captive and still have the benefits that they would have if they were owning or renting a captive of their own. They could just do it at smaller premium thresholds. This is a little bit about rental captives. They're formed and regulated in their domiciles. They don't retain risk for their own account, and that's an important factor because when you a rental captive has to be fully secured. Whatever risk they assume, they have to either have cash or letters of credit to back that up, so that they never have their capital and their surplus at risk. Segregated sale captives, that just creates a wall between the different entities, so that your money is separated off from other money and other renters in the captive. And there's all kinds of variations of them, so that you can make different elections, mainly for tax purposes. Reinsurance. Most captives will function as a reinsurance company, not as an insurance company. And what does that mean? Well, reinsurance companies are companies that sell insurance to insurance companies, to other insurance companies. So when an insurance company doesn't want to retain all the risk themselves, I used to do this quite frequently. We would call up our friendly reinsurer and say, I don't want to retain the next $500,000. I'll take 20% of that if you'll take 80%. I pay them a premium for that. They pay me a ceding commission for that. And everybody goes home happy. So most captives function as a reinsurance company because captives are not regulated by the state insurance domiciles. So the Department of Insurance doesn't regulate say a Bermuda captive or a Cayman captive. So again, they're used to transfer risk among insurance companies. This is just some terminology that you might hear. You know, when we place business with a reinsurance company, we are ceding to the reinsurer. Is just a terminology. And the reinsurer is paid a reinsurance premium by the ceding company, and then the reinsurer turns around and many times will pay a commission back to the ceding company. This is a fairly typical structure of a captive, where the captive is a reinsurer, because we need an insurance company. If we have workers' comp, we need an insurance company, unless we're qualified self-insured. For automobile, we need an insurance company. General liability, probably going to need an insurance company because somebody's going to want to see a certificate of insurance. So we always have that insurance company there, and that's where the captive tends to act as a reinsurer.
So to present to the outside world, we need an insurance company wrapping the deal.
Right. So what we'll have is we'll have an insured paying premium to the insurance company, the insurance company paying premium or ceding premium, reinsurance to the reinsurer, the captive. The captive will pay claims back to the insurance company. The insurance company will pay losses to claimants, and the insured, as you can see from the captive, will get investment income and underwriting profit, and the insured may or may not have to post a letter of credit to the captive. It just depends. But this is a fairly typical structure of the way a captive will be set up. In risk, we have two different types of risk. We have severity risk, which is the vertical. That's the really bad loss. So I had $1 million loss. Only had it one time. And then we have the horizontal, which is frequency, which means I may have 50,000 loss, but I may have it 50 times. So we insure for both of those. So what we do is there'll be a certain amount of retention that the captive has, and then there'll be insurance or risk transfer above that number. In this case, it's above $250,000. That's real risk transfer, real insurance. And then we'll have across the bottom, after we paid $500,000 in this example of losses within the first $250,000, once we pay $1 million, then we have real risk transfer again for all losses less than within the first $250,000 that we were assuming. One of the reasons that collateral is required is generally the insurance companies and reinsurance companies that will cover the frequency part of it, which we call the aggregate reinsurance, will not attach at whatever we fund the captive. So in this case, if we fund the captive at $500,000 and our reinsurance doesn't attach until $1 million, then we have a gap. And that's what generally gets collateralized in that case. Most of the group captives will have what they call an A fund, B fund. The A fund being the losses, the individual losses that are retained by the insured. And then above that, let's say between 50 and 250 is the losses shared within the group. And then they'll buy real insurance above that, say above 250. And generally the gap on a lot of these group captives are whatever they forecasted the losses to be from $1 to $50,000. That's what you paid in plus expenses. Then they'll want that money. They'll want one more time that money to cover the gap. In the event that they run out of money before they run out of loss. In a captive structure, this is kind of how the expenses kind of break down. Percentages can be different depending on the lines of insurance, but you'll pay a front fee. That's what you pay the insurance company to issue the policies that we need, work comp, automobile, general liability. We'll buy the reinsurance, which I saw in the boxes, to cover our severity losses, cover our frequency losses. We'll outsource our loss control. We'll outsource our claims administration. We'll still have boards, bureaus, and taxes paid to the states. We'll still have our residual market for the funding, and then we'll have our loss fund. So as you can see here, 41% is going to expenses, 59% goes to pay the losses. What if I don't spend the 59%? What if 100 pennies in a dollar? You have 59 cents to pay a loss. What if I spend 40 cents? Who keeps the 19 cents? The insured does.
Each insured has buckets for loss funds that if they're not burned up, they get them back eventually after they close out the policies.
And actually we can add...
Plus investment income.
And actually we can add a little bit to this because investment income is added to the 59%. Capitalization, if you decide to own a captive, whether it's an 831B or a different type of captive, the domicile, whether it's South Carolina, Georgia, Vermont, Bermuda, Cayman, they all have requirements on minimal capitalization, which has to be met, and it depends on the type of business you're putting in there and the amount of rented business that you're putting in there, the amount of premium that's going into the captive. Captives can use debt, equity, or a mix to meet the capital requirements. And captives may need to raise additional funds when it falls below the minimum levels. At any time during the life of the captive, they can either use the profits to recapitalize, or they can have what they call a capital call on the owners. And when I was at Discovery, we did a lot of captive work in a different division and did a lot of group captives. And let me tell you, nobody was happy when there was a capital call. And that generally happens when the losses are worse than you anticipate. Again, why is collateral needed here? We're securing the gap between the risk assumed and funded by the captive and the attachment of the stop-loss reinsurance. The fronting company who's issuing the paper wants to make sure that the captive can actually reimburse them for the losses that they're going to pay, because they can't take credit for the reinsurance. Reinsurers that are very large, like Gen Re, Munich Re, people deal business with them. The captive reinsurers don't have a financial rating, and so the insurance company may not be able to take credit. In fact, they can't take credit for reinsurance ceded to the captain in most cases, unless the captain is extremely large and has been rated by one of the
Some of them
rating
actually got
bureaus.
big enough to get ratings.
They do, some of them have. And they're securing the risk of the captive members in the fronting insurer because, again, if you're in a group captive, they want to make sure that everybody in the group is actually contributing as outlined in their contracts. We always like to stress the importance of professional tax and accounting advice. You know, we're in the insurance business here, and we can't really tell you how to take, you know, what you're going to take as a tax deduction, when you can, you know, when you have to declare income in your captive. All those things are matters for tax professionals. There's a tremendous number of IRS rulings on it, but it is the domain of tax and accounting professionals, attorneys, lawyers. They'll all be involved if you decide to go down one of these routes, most likely. And I'd like to thank you for your attention today, and if there's any questions, I'll be happy to entertain those at this point. So I can tell you, I sold the heck out of it when I was working for another firm, because, you know, if you had a private business and they were very wealthy, you know, we just seed tons of money into the captive, and then, you know, those underwriting profits would go to their, we'd seed up to the maximum, which used to only be 1.2 million. And we would, you know, use it as an intergenerational wealth transfer vehicle. But those, like I said, the government figured that one out and ended that one this past January.
Also, a lot of these have been promoted purely on tax benefits, and IRS really doesn't like that. And if they audit them, they want to see some real legitimate risk transfer involved, and so there's, you know, it's important that if you did do one of these, you have good advisors on all of that, because that's something that they're targeting.
Yeah.
If you never pay a claim out of your captive, that's not a good thing. And there's many of them that probably never pay a claim.
Yeah, right now the 831Bs are pretty much on the hit list of the IRS. If you have an 831B captive, chances are, you know, you may be getting a knock on the door, somebody wanting to audit the books on that. Because that can be a domestic domicile or it can be an offshore domicile. But anyway, long answer to a short question.
No, I appreciate it. Good stuff.
Anything else? Well, again, I appreciate it. Oh, yes.
Sorry, quick question. Do you find with any of those, the different solutions you talked about, being an issue with people and their clients that require certain levels of insurance coverage and not accepting these alternative forms?
They are, with the exception of self-insured retention, the vendors don't have any idea what's happening behind the scenes.
And that's the reason for the collateral. So like if we would do a large deductible for y'all, we would issue a certificate that shows guaranteed cost. I mean, it looks like a guaranteed cost certificate because the carrier is responsible for the deductible.
Yeah, they're going to pay the client
and
first dollar.
And they've got credit risk on you because they're relying on you to refund them for the deductible, and that's the reason for the collateral.
Yeah. Yeah.
So they're fully secured on their exposure.
I will tell you, self-insured retention is a whole other animal. I go back into my past. You know, a good example of that is, let's say that you're a business and you decide that you're going to do a self-insured retention versus a deductible, okay? And you're naming somebody as an additional insured on your policy, on your GL policy, and that additional insured has a claim as a result of the imputed negligence. So the first thing you do is the additional insured calls Doug or me or somebody here at Sterling, and they say, we have a claim and we want the XYZ insurance company to defend us. And I'm going to say, we're real sorry about that, but our client has a $50,000 self-insured retention. So you have to go back to your client that issued this, you know, that you're doing business with, and you got to seek your defense from them, not from the insurance company. The insurance company is going to go, hey, we don't owe you a defense. You have a self-insured retention. We don't do anything until the self-insured retention is exhausted.
We write some coverage with self-insured retentions, but the bulk of the folks who use these big self-insured retentions will be giant companies like, you know, Home Depot and, you know, Fortune 1000 Food Lion he mentioned.
Yeah, well, Food Lion did, but I would tell you, one of my former clients was Georgia Pacific, and they took a $2.5 million deductible because they needed to certificate first dollar insurance, and so they bought a deductible, and of course, because they were so financially worthy, and we didn't have to secure a lot of what we expected the losses to be in the first $2.5 million. But
because they're an investment grade credit,
yeah,
so
they're
they count their
investment grade
receivables from Georgia Pacific.
yeah, so we may have collateralized 25% of the expected losses within the $2.5 million, but we issued a policy for a $5 million limit with a $2.5 million deductible because Georgia Pacific didn't want to show the SIR.
The majority of our clientele, which we would consider middle market, would probably be more interested in a large deductible or a retro or a group captive.
out of all these different alternatives. The self-insured retention, probably not so much, because it's just, it's because of that third party.
It's a certificate issue.
Yes.
And it can be, like I said, you can be a middle market or you can be Georgia Pacific, doesn't matter. Well, thanks again to everyone
Thanks,
for
guys.
coming out today. And no alternate facts today.
Thanks, Ben.